Well, thank you very much, John, for that kind introduction. Good evening, everyone. It's always a pleasure to be back at my alma mater. It's such an incredible place, and when you come back, you just say, you know, this is really a dream come true to be part of this university, as I did several years ago. It may sound like a mutual admiration society, but let me say this about John Gunn and his team at Dodge & Cox. I've been 40-plus years in the business world. I have met with hundreds and hundreds of investment companies. I have known John and his Dodge & Cox colleagues for nearly 25 years, and I would rate them, if not the best investment company in this country, certainly among the top 3 or 4 in the United States. Their long-term track record of investment returns is unequaled. So well done, John and Dodge & Cox. I wasn't able to attend all the presentations today, but for those I did attend, and from what I heard during the cocktail hour, they were well received and were very interesting. So congratulations to this organization for putting on this terrific forum. For this evening's talk, the direction I received from George Schultz and John Chauvin was very clear and very blunt. Even a banker could understand it. They said, please explain what in the hell happened, why did it, and how might we avoid it happening again? So that's pretty straightforward. So I'll get right into it. But before doing so, let me read you a very interesting quote. And while I read this, think about who it's from. Quote, owners of capital will stimulate the working class to buy more and more expensive goods, houses, and technology, pushing them to take more and more expensive credit until their debt becomes unbearable. The unpaid debt will lead to bankruptcy of the banks, which will be nationalized. The state will then have to step in to save the banks, which will eventually lead to communism. Who said that? Karl Marx in 1867. Pretty scary, isn't it? With that good news, I'll go forward. This is the 6th economic recession that I have experienced in my business career. The worst one so far was back in the early 1980s. I know some of you remember it. We had the Arab oil embargo, 14% inflation, 20% interest rates, 11% unemployment, and a very, very restrictive monetary policy. The vast majority of savings banks failed, as well as many commercial banks, especially in Texas. The Continental Bank in Chicago failed, which at that time was the largest bank failure in U.S. history. It was actually nationalized and sold 7 years later. Banks were saddled with LDC debt that needed to be restructured, especially in Latin America. By the way, if banks had to mark-to-market their LDC debt back then, as we do now with so many assets, every, and I mean every, money center bank would have been bankrupt with practically no access to additional capital. Now, although the economy has still not hit bottom by any means today, today we have 8.1% unemployment, record low interest rates, low core inflation, and the most expansive monetary and fiscal policy in the history of the United States. In stark contrast, the inflation was so high during the 1980 recession, the Federal Reserve mandated that banks reduce their lending, not increase it like they are demanding today, in order to slow the inflationary economy. Banks face fines and other sanctions if loans outstandings increased. Banks totally cut off their lines of credit to their customers. In spite of such dramatic differences, most everyone thinks this is the worst economic crisis since the Great Depression. Why is that? I would call it the worst financial crisis, perhaps, since the Depression, but I believe the 1980s was economically much worse than this one, at least so far. So, what did happen? Why did it happen? What is different about this recession? What is different is that in all the previous banking crises, it generally started with the bank's customers having problems due to macroeconomic issues and the economic cycle. This eventually led to credit problems and the write-down of loans and assets. This time, financial institutions themselves caused the problem, not broad economic factors, not the economic cycle, not misguided fiscal or monetary policy, not an oil crisis or a market disruption. Let's be honest. This problem was caused by a total disregard by financial institutions' management of basic risk management fundamentals, even common sense, coupled with a serious lapse in ethical behavior. It was fueled by greed, unchecked by regulatory authorities, and reached an unprecedented scale due to the breakdown in previously reliable third-party safety valves, namely rating agencies. Let me ask you these questions. Is it ethical to record on a mortgage application an income that you know is wrong? Is it appropriate for a firm to sell investors a security that the firm itself is shorting? Isn't it just common sense that, especially for subprime borrowers, that stated income, negative amortization, teaser rates, no-doc and low-doc mortgage loans, primarily originated by brokers, are inappropriate, should never have been offered, and are an open invitation for fraud? Could this subprime fiasco have reached the bubble level it did without AAA ratings from rating agencies? Could it have reached that level if mortgage brokers had been properly regulated by their state agencies? Aren't all of these relevant questions that we should be asking so that we learn from our mistakes? What is so unfortunate and so puzzling about this crisis is that it should never have happened. It was not caused by normal economic issues. It was caused by human error and human malfeasance. Perhaps this is why we have had to use such non-traditional methods to try to fix the problem. The old tools aren't working because the cause of the crisis is so unique and so different. It reminds me of the story of three men who were about to be executed during the French Revolution: a soldier, a politician, and a banker. The soldier put his head on the guillotine. The blade stuck. He went free. The politician put his head on the guillotine. It stuck again, and he went free. So the banker was next in line. And he'd been watching all of this, and he looked up at the blade, and he said, "I see the problem. Oil the hinge." Yes, we bankers often cut our own throats. The seeds for today's problems were sowed in the 2005 to 2007 time period when credit risk spreads were the lowest they had ever been across almost all asset classes, 50% or so narrower than their long-term averages. The market was pricing as if there was no risk. Many investors were looking for just a little more incremental yield, while they generally ignored the very substantial increase in incremental risk. This opened the door for the greed and ethical lapses that I mentioned earlier. Cleaning up this mess has unleashed massive monetary and fiscal stimuli never before contemplated, yet alone used, not even during the Great Depression. Incidentally, there have been many articles and comments in the media comparing the current economic challenges to the Great Depression. Factually, there is not even a close comparison. The Depression's loss in GDP was about 10 times the decline in all the recessions we have had thus far in the 20th century combined. In the early 1930s, GDP fell by about 30%, industrial production by almost half, unemployment exceeded 20%, and of course the Depression lasted a long time, practically the entire decade of the 1930s. In fact, unemployment did not fall to single-digit levels until the beginning of World War II. We are far from these dire economic levels, and I see no chance of even getting close, given the coordinated fiscal and monetary policies taking place around the world. The fourth quarter GDP decrease of 6.2% is startling to many, but we forget that we have had quarterly decreases in GDP of around 5% or more in many past recessions, including 1948-49, 1953, 1958, 1960, 1974, and of course, again, the very difficult early 1980s. Nevertheless, the recent economic changes have been dramatic. In the past year alone, we have seen stock markets across the world fall by half, erasing $35 trillion from investors' portfolios, about $8 trillion in the US markets alone. For most Americans, their 401ks now look more like 201ks. Americans' net worth has tumbled by $11 trillion in the past year. That's equal to the annual output of Germany, the UK, and Japan combined. An unprecedented $10 trillion has been pumped into the US economy by the government, the Federal Reserve, the US Treasury, and the FDIC through asset purchases, loans, debt guarantees, equity investments, and fiscal stimuli. Some of you remember Senator Everett Dirksen, who used to talk about $1 billion here and $1 billion there being real money. That's chump change now. We talk today in trillions. Consider some of the other startling financial changes in the past year. Fed funds reached a high of 4.25 and a low of 0. If you go all the way back to 1800, the average yield of the 10-year Treasury has been about 4.5%, compared to about half that at times this past year. Commercial mortgage-backed security spreads to swaps reached a high of 1,500 basis points this year and a low of 90 basis points. And of course, we all know that crude oil prices peaked at $147 a barrel and reached a low of $33 a barrel. We have never experienced such dramatic changes in such a short period of time. We have gone from asset spreads reaching all-time lows and being extremely overvalued to significantly undervalued today. And that's what happens when bubbles burst. This time led by the housing market, as home prices increased an unprecedented 125% between 2000 and 2006. In the current credit crisis, bankers have been accused of being heartless, refusing to make loans, and unwilling to make mortgage modifications, thus prolonging the credit crisis. It reminds me of the advertisement in the San Francisco Chronicle for a heart transplant. Perhaps some of you saw it. For the heart of a Nobel Prize winner, the cost was $50,000. For the heart of an Olympic champion, the cost was $100,000. But for the heart of the banker, the cost was $200,000. Now, George Schultz's wife, Charlotte, saw this ad, and she said, "George," as she always says, "George, how can the heart of a banker be worth 4 times that of an Olympic champion and twice that of a Nobel Prize winner?" "Simple," George said. "It's never been used." Let me ask you this. Is it inevitable that we have a banking crisis every 6 to 8 years, as has been the case for the past 3 decades? Is it just the capitalist process that financial innovation often leads to excesses, creating financial bubbles that when they burst, trust me, they always will, causes economic shifts that often leads to recessions? Is this just the price we have to pay to gain the extraordinary economic benefits of the free enterprise system? Well, I don't believe it is. I believe the extremes of the bubbles, the tails, if you will, could be largely avoided. Sure, we will have issues, mild recessions, and the normal ups and downs of the economic cycle. These are likely unavoidable. But because we have so much more economic knowledge today, smarter and more proactive central banks, more knowledgeable and effective regulators, these cycles should be less severe, less frequent, and of shorter duration. In fact, this has been the pattern of recent downturns until now. But what about the hyperbubbles that we have experienced, such as the internet bubble and the housing bubble? What can we do about those? How can we avoid them and thus mitigate the carnage when the bubbles burst? What can we, the bank management, boards of directors, regulators, do differently to reduce future problems, especially problems of systemic risks caused by the bursting of bubbles? For the answer, we must first look in the mirror. We, the management of the financial services industry, must do a much better job of risk management. We, the financial services industry, must be more accountable and responsible. We, the financial services industry, must change our culture and our incentive systems. Should we decide to make these changes, not only will our economy and society be better off, but so will our stockholders. Now, my goal is not to convince you that I have all the answers, because I certainly don't, but rather to engage you and others in this important forum in the discussion and the debate. The premise of my proposition relative to financial institutions is this: doing the right thing is the right thing to do. If you think it is wrong, it probably is wrong. Just because someone else is doing it doesn't make it right. Losing market share because competitors are not pricing for risk, or making unsound underwriting decisions, or even crossing the line of responsible and ethical behavior will benefit you in the long run. Why? Because the cost of cleaning up the mess in terms of the write-offs and loss of market share during the cleanup, including the long-term cost to your reputation, will cost you 2 or 4 times more than that which you gained during doing the wrong thing. Just look at what it's costing the industry today. Over $1 trillion in worldwide write-offs. Some say it may go to $2 trillion. A $4.7 trillion reduction in market value of financial institutions from peak to trough so far. Banks have struggled to raise $1 trillion in new equity. Early on, some of that capital came from the Middle East. For a while there on Wall Street, it was either Mumbai, Dubai, Shanghai, or goodbye. Eventually, it became goodbye, as there are no large investment banks left. Making mistakes in the risk business just never pays. Never. Now there is essentially no private capital available to banks. It's all coming from the governments. So here are some things we might want to consider that could significantly reduce future incidents of aberrant behavior by financial institutions. Now, I know this may sound Pollyannish, but stick with me for a moment. First, and perhaps most important, is what I would call management by culture. I define culture as knowing what to do without someone telling you what to do. Most financial services companies today are large, multi-product, multi-geographic, and hugely complex. Their various divisions provide different products to different customers in different markets. They can't be controlled and directed centrally. In fact, much of the responsibility and accountability for results must be decentralized to business heads, often far away from headquarters, in order to respond quickly to customers and ever-changing markets. Today, a command and control or hierarchical management structure for large and complex institutions just doesn't work. Even though most businesses that make up financial companies today are different, Wells Fargo has close to 100 different businesses, for example, what they can share and what they must share, in my opinion, is a culture with similar vision, values, operating philosophy, risk appetite, and policies. Some call this tone at the top, but that tone has to be heard and be sung at the bottom where it counts. In such a decentralized and geographically dispersed model, line management must be responsible and accountable for both risk and returns. In addition, however, there must be a strong, effective check and balance system that includes internal audit, risk asset review, and an enterprise-wide assessment of risk for such areas as operations, credit risk, and interest rate risk. These checks and balances supplement the risk process, but they are not a substitute for line management being ultimately responsible and accountable. Risk management is not about mathematical models. It is all about people. Group heads, COOs, and CEOs must be carefully selected for their judgment and risk-reward balance. They must be hands-on, know what's going on, understand the risk, and very importantly, the tails of the risk, to ensure that the operating units are adhering to the corporation's values, philosophy, and risk policies. These values and policies must be communicated throughout the company effectively, consistently, and repetitively. Now, there are many ways to embed a culture in any institution, be it a for-profit or a not-for-profit company. One way we do this at Wells Fargo is through this booklet, The Vision and Values of Wells Fargo. First published 16 years ago, it is updated about every 2 years. It describes our vision, values, operating philosophy, and the culture of our company. We believe so strongly in a unified company culture that we will not acquire any company or enter any business unless we believe it is culturally compatible. As you recall, many banks bought large full-line investment companies in the late 1990s. We did not. It is not that we thought offering our commercial clients M&A advisory services or capital market capabilities wasn't a good idea. We just felt that the culture at large investment banks was incompatible with ours. We are a relationship-focused company. Large investment banks are often transactionally focused. We are a team-focused company with team incentives. Investment banks are often individually incented with highly paid stars. We believe that investment banks often cross the line in pursuit of deals and market share. In short, we felt the employees of investment banks would not accept our culture, and we could not accept theirs. So it would be a disaster for both parties. In fact, we predicted that 6 out of 10 of those large commercial bank, investment bank mergers would not work. We were wrong. 9 out of 10 didn't work. Today, no large investment banks even exist. The only 2 left, Goldman Sachs and Morgan Stanley, are now bank holding companies. Another example. How is it that Wells Fargo, the largest mortgage originator in the country, missed the bulk of the subprime debacle? Why is it that we decided that for subprime borrowers, we would not originate any option adjustable rate mortgage loans, any negative amortization mortgage loans, any stated income or no doc, low doc mortgages? Why did we do that? Even though we could have sold, and as we do with all of our mortgages, 100% of these loans in the secondary market at presumably no residual risk to our company. The answer is on page 8 and 9 of our Vision and Values booklet under the heading Responsible Lending. Let me read an excerpt to you. Every loan we make must provide a demonstrable benefit to the customer, or we won't make the loan. 2, we will make diligent efforts to determine that customers have a high likelihood of repaying a loan before we offer it, and they commit to it. 3rd, it is totally contrary to our vision and values to attempt to sell a customer any product or service that's not in his or her best long-term interest. So the decision was pretty easy. The head of our mortgage company, Mark Oman, came to me in 2005 and said, I don't think we should do the crazy things that are going on in the subprime mortgage market because it violates our vision and values and our responsible lending principles. He said, we will lose market share, but it is not right for our customers or our company. I quickly agreed. There was really no long discussion and no hesitation. And we lost, by the way, 4% market share each year for 3 years. $160 billion we lost in mortgage originations in 2006 alone. Similarly, Dave Hoyt, head of commercial banking, decided not to pursue CDOs, CLOs, CIVs, and highly leveraged loans to private equity firms, all of which became problematic in this crisis. Now, I share these examples with you not to praise Wells Fargo, as we were far from perfect and we made other mistakes that we shouldn't have made, but to demonstrate how powerful both culture and line management responsibility can be to avoid at least some of the major problems. But it takes, of course, more than a booklet. Here are some other essential ingredients, in my opinion. The management team, especially the senior management team, must walk the talk. Everybody is watching not what you say, but what you do. In selecting people for top management positions, an essential ingredient should be their understanding of, belief in, and demonstrated commitment to the accepted culture. Because culture is so important to results, promotions are generally from within the company. Most of the top management has likely spent the majority of their lives working at that company. They must live, breathe, teach, and walk the talk of the culture. The incentive system is also critically important. If your incentive system is geared to short-term results, you are asking for trouble as a financial institution. The majority of incentive pay at the senior level should be long-term in nature, such as stock options, which of course are long-term, dependent on total company results, and align with the interests of stockholders, who are the owners. Importantly, however, every stock option recipient should retain at least 50% of all after-tax exercise stock options until retirement. 50%. This incents people to focus on the long term, work as a team, not take shortcuts, not do dumb things for short-term gain. There should also be a clawback provision for cash bonuses should it be determined that past earnings were improperly recorded. Another important tool that may surprise some of you. I believe that such broad statements as corporate objectives and a firm's underlying business model are critical to avoiding serious mistakes. This assumes, of course, that you walk the talk and do what you say. For a financial institution, long-term objectives should include, first, a conservative financial position measured by asset quality, accounting policies, and capital levels. You should want such a strong balance sheet in your bank that your customers would put their money in the bank even if there was no FDIC insurance. Second, annual growth in earnings and revenue that are aggressive but not exceedingly so. Third, return on assets and return on common equity at relatively high levels in the top quartile of the industry. Now, why are these important tools? Well, if your number one goal is financial conservatism, how can you originate loans without adequate covenants? Make highly leveraged LBO loans with practically no covenants. Leverage your balance sheet to 50 times equity. Similarly, if your financial goals require high returns on equity, how can you price assets without adequately charging for risk? Balloon the balance sheet with assets that are of low return. How can you have an earnings growth rate objective of, say, 15% every year and still invest in the business without taking excessive risk or crossing the line? Another important element to avoiding excesses is a business model that can perform reasonably well in any economic environment. A business model that is well diversified by product, geography, and industry. We all know that every segment of the financial services industry is cyclical, which is the bad news. The good news is that the cycle varies by segment. Some segments are even counter-cyclical. Like now, when the stock market collapses, bank deposits increase because investments park their funds in banking accounts. Similarly, in high-rate environments, which usually corresponds to a strong economy and which the Fed is trying to slow, mortgage volumes decline, but other segments are growing and credit losses are low. In low-rate environments, like now, when the Fed is trying to stimulate the economy, credit losses are usually elevated and many segments are struggling, but the mortgage market is often booming, which it is today because of refinances. So if you are diversified, you can often ride out the highs and lows of the various segments. Diversification helps you to be more conservative, prudent, and disciplined, which will allow you to perform better than the industry because you won't pay the severe price of cleaning up the big mistakes that result from staying the course even when the winds are against you. Some people have suggested that this financial crisis was caused by the repeal of the Glass-Steagall Act, which allowed financial institutions to broaden their product lines to include all financial products. Nothing could be further from the truth. In fact, when you look at the survivors of this crisis, you see that the most diversified survived, even though they made similar mistakes as to the companies that are now gone. Diversification is absolutely essential to effective risk management. I would also caution to not over-rely on mathematical models, even though some of those models are taught right here at the Stanford Business School. They rarely can take into account wing risk. In fact, 99% confidence levels are not sufficient in our business. The last 1% of the risk can bankrupt a financial institution. Finally, let me mention 5 other areas that should be addressed to avoid or at least mitigate the reoccurrence of systemic risk crisis. Perhaps the most important contributor to the severity of this financial crisis as compared to others was the role of the credit rating agencies. I just can't believe that they could rate any subprime mortgage security AAA. Common sense and experience should have overridden their mathematical models. If the rating agencies had been doing their job, we might have avoided the majority of the issues related to subprime borrowing, and the housing prices would never have reached the levels that they did. Would German savings banks have invested in United States subprime mortgages without the AAA rating? Another problem that needs to be corrected is the procyclical nature of certain accounting policies, namely the reserve for loan losses and mark-to-market accounting. Such policies needlessly accentuate the credit crunch, illiquidity, and credit availability. Why, in God's name, do you mark something to market when everyone agrees the market is not functioning properly? Why would the Fed and the government invest $10 trillion of taxpayers' monies to fix the market if it was functioning? Mark-to-market accounting is fundamentally not about a quote on a screen. It should always be about expected cash flows. However, when a market is deep and functioning properly, the screen price should approximate expected cash flows and is an appropriate shorthand method for market valuation. When markets are not functioning, the screen is not reliable, and you should have the option of using the longhand method of expected cash flows to value assets, which importantly should be carefully reviewed by outside auditors and regulators to ensure that the calculations are accurate. We must also change the timing of when to build the provision for loan losses. We should build the loan loss provision in the good time because those are the loans and assets that will be written off in the bad times. That's the purpose of reserve accounting. Ladies and gentlemen, I'll tell you a little secret. Over 90% of all the loans and assets that the banking industry wrote off in 2008, all $1 trillion worth, were originated in 2005, 6, and early 2007. The very time period that the SEC, FASB, and the accountants would not allow financial institutions to build credit reserves because, according to them, there was no immediate proof that losses would occur in the future. That's right, I said 90%. This during the time that, at least in my opinion, asset spreads made no sense, were at all-time lows, and were priced as if there was no risk. If that's not a sign of trouble sometime in the future, I do not know what it is. We should also reinstate the uptick rule relative to shorting stocks, and the law against naked shorts should be strictly enforced. Finally, we must admit that our regulatory system failed us. Because state regulators failed to monitor mortgage brokers, there was widespread fraud. The SEC failed to check the high leverage and liquidity risk of investment banks. Banking regulators allowed off-balance sheet vehicles and credit risk to get out of control. We must change our process of regulations and regulators so that all of those companies who do the same thing are regulated in the same way, regardless of legal entities. Now, I could go on and on with suggestions to consider that would help mitigate the excesses of past cycles, but time will not allow. Suffice it to say that I sincerely believe that we can use some of these tools to reduce the occurrence of systemic risk bubbles. I firmly believe that the benefits far outweigh the cost, and that these and other suggestions can be implemented without serious risk to financial innovation and competitiveness. By doing so, our nation's economic growth will be increased and be more consistent, and so will the results for our stockholders, our customers, and employees. Before closing, let me say a few words about the economy. GDP in the first quarter will decrease by 5% or more, following a 6.2% decline in the fourth quarter, and will likely be negative next quarter, but hopefully at a reduced level. Unemployment will soon be over 9% and approach 10%. Yes, our economy is suffering due to the almost $2 trillion of deleveraging of consumer and corporate balance sheets and the rise in consumer savings rate, which is reducing purchases. Prior to the recession, the country's savings rate was essentially zero. Consumers were spending everything they earned and borrowing to spend even more. This juiced consumption and the economy to unsustainable levels. It is now being reversed. The consumer is saving their reduction in gasoline prices and their stimulus checks. The savings rate has jumped from 0 to 6%, the highest rate in 14 years, and is heading toward the 10% savings rate reached during the 1980 recession. In the short run, this hurts the economy, but in the long term, it is positive. The reason we will start to see growth soon, hopefully beginning by the fourth quarter or early next year, is the enormous monetary and fiscal stimuli that are in the pipeline. And let me emphasize, if the current amount is not sufficient, more will come. If you don't remember anything else I say this evening, remember 3 words: whatever it takes. That's what every central banker, finance minister, president, and prime minister is committed to. Whatever it takes to get their economies growing again. If you want to bet against them, you do so at your own peril. Conventional wisdom says the economy is suffering from a liquidity crisis. That's not correct. Cash holdings in households and non-financial businesses are actually at an all-time high, at about 70% of GDP. This abundance of cash is ready to be invested as soon as the bottom is reached. Conventional wisdom says we are likely to see a fairly slow increase in economic activity once the bottom is reached, and it might take years for the economy to reach its potential. Because of the incredible stimulus in the pipeline, very low interest rates, and the huge pot of available liquidity, I think the economy is likely to increase quite substantially once the bottom occurs, and the economy will reach its potential much faster than most people think. The risk to future economic growth will come later, in my opinion, after everyone thinks the crisis is over and we will once again grow to the sky. The danger, in my mind, is not that we don't start growing again. The danger is that we will have to pay for this extraordinary stimulus 2 or 3 years after the economy fully recovers, perhaps with stagflation. As the stimulus is removed, we pay the cost of our extraordinary budget deficits. To make my point, it is estimated that the Treasury will issue $1.8 trillion in bills and bonds this year, which, when combined with the $1.5 trillion last year, exceeds all the net borrowing by the U.S. Over the prior 27 years combined. So, in conclusion, if you wonder whether or not the credit crisis will ever end, just remember those 3 important words: whatever it takes. Thank you for your attention. As I understand it, there will be time for questions and comments near the end of the dinner. Thank you very much.